Imagine waking up, not just, without that gnawing stress of financial uncertainty, but actually feeling excited about your financial future.
Hmm. That's the dream, isn't it?
Totally. What if you knew exactly how to make your money work for you? Not just like for the bills and basic needs, but for your biggest dreams.
Yeah, because for so many people, the whole financial world just feels, well, complicated, maybe even rigged, like this jungle of confusing jargon, hidden pitfalls, all seemingly designed to drain your wallet.
Exactly. It feels like a game you can't win. But what if there was a clear path? A simple blueprint, maybe, to not just survive, but to actually thrive, to build real, lasting financial peace.
And that feeling of control, that security, that's what so many are searching for, that sense that your future is really in your hands, not just something for the super wealthy.
Absolutely. And that's precisely why today we're taking a deep dive into an extraordinary book that tackles this head-on, Tony Robbins' Money, Master the Game.
Ah, beast of a book, but incredibly valuable.
It really is. It's not just a book. It's like a comprehensive guide, meticulously designed to cut through all that noise and confusion we were just talking about.
Right. It aims to reveal the actual strategies used by some of the world's top financial minds, the real players.
And give you, the listener, the actionable tools to create genuine financial freedom. So our mission here in this deep dive is to really distill the core wisdom from this massive work.
We want to show you the fundamental problems it solves, get into the core ideas you absolutely need to grasp, and crucially, how you can start applying them immediately, like today.
Okay, so let's kick things off by confronting the reality this book addresses. What problem does Money, Master the Game actually solve, and why does it matter so much right now?
Well, because for most people, money isn't just numbers on a screen. It's a huge source of stress, like a constant low-level hum of worry in the background of daily life.
It's pervasive, isn't it? The book throws out some pretty stark numbers.
Oh, absolutely sobering. Get this. Tony Robbins cites data showing that a staggering 77% of people in America live with significant financial worries. 77%.
Wow, that's almost 4 out of 5 adults.
Exactly. And maybe even more telling, 60% admit they don't have any kind of spending plan or investment plan. None whatsoever.
So it's not just about feeling a bit short on cash sometimes. It's this deep, widespread stress affecting, well, everything. Mental health, relationship.
Everything. And it's debilitating for so many.
And it's not just today's bills, is it? The book really digs into the uncertainty around retirement. That feels like a huge cloud hanging over people. The whole traditional idea seems to have evaporated.
You've really hit on a crucial point there. Over half of American households are actually classified as at risk for not having enough money in retirement. Not enough to maintain their current lifestyle, let alone improve it.
Half. That's massive.
It is. And think about this. Over a third of working Americans have less than $1,000 saved for retirement, excluding pensions or home equity, which fewer and fewer people can rely on.
Right, the traditional pension. That promise of lifetime income.
It's become a relic, as the book calls it, a financial dinosaur. Very few private sector workers have one now.
Which means it's all on us, right? The responsibility for our financial future is squarely on our shoulders.
100%. And that feels overwhelming if you don't have a clear map, a clear guide.
And then there's the kicker. We're living longer. Which is great news, obviously. More time, more experiences.
A huge blessing. But financially, it's a monumental challenge.
Because financing a longer life just requires a much, much bigger nest egg than our parents or grandparents needed.
It really does. 50 years ago, the average retirement might have been, 12 years? Now, someone retiring at 65 could easily live to 85, 90, even longer.
So 20, 30 years of retirement isn't uncommon.
Not at all. And the book highlights how unrealistic it is to fund a 30-year retirement with maybe only 30 years of work, especially when you look at how little people were saving historically. Like that tiny 2.2% personal savings rate back in 2013.
Ooh, yeah, that math just doesn't work.
It doesn't. So the fear of outliving your savings, running out of money when you need it most, that's a very real, very pressing anxiety this book directly tries to solve.
Okay, so it's not just about our individual saving habits or lack thereof. The book argues the system itself has some pretty serious design flaws. It kind of pulls back the curtain on some uncomfortable stuff.
It does, and that's such a vital insight for people to grasp. A core issue Tony Robbins really hammers home is the inherent conflict of interest within many large financial institutions.
How so?
Well, they present themselves as your trusted advisor, right? But often, their structure is set up to maximize their profits, not necessarily yours. You might think you're getting unbiased advice tailored to you.
What, really?
But really, you might just be paying for the privilege of being sold suitable products. Products that make the firm money, maybe through commissions or higher fees, which might not actually be the absolute best option for your specific goals and returns.
It's a subtle misalignment, but it can have huge consequences over time.
Huge. And most people aren't even aware it's happening.
And it gets even wilder when the book talks about things like high-frequency trading, HFT. That sounds less like investing and more like, well, like the market's rigged against the little guy.
The book does a great job exposing how HFT works. We're talking about a world where 50 to 70% of the millions of daily stock trades aren't even made by humans. They're generated by super-fast computer algorithms.
50 to 70%. Wow.
Yeah. So what does that mean for you placing an order on E-Trade or Schwab? Well, in the half-second it takes your order to execute, these big boys with their supercomputers have potentially bought and sold the same stock thousands of times, skimming tiny profits off each trade.
So they're essentially front-running my order.
In effect, yes. Michael Lewis, who wrote Flash Boys, is quoted in the book saying the U.S. stock market is rigged by a combination of the stock exchanges, the big Wall Street banks, and high-frequency traders. It's a blunt assessment.
And the example of spending $250 million just to shave milliseconds off trading time.
Isn't that incredible? Spending $250 million to straighten fiber optic cables between Chicago and New York just to cut transmission time by 1.4 milliseconds. It perfectly shows the extreme lengths they go to gain this tiny fractional second edge.
An edge the average person just can't compete with.
Not a chance. It's a game of speed and tech we're not equipped to play.
And beyond the mechanics, there's the constant noise from financial media. The book calls it financial entertainment more than actual news. It feels designed to confuse us, maybe keep us anxious.
That's exactly the point. This relentless stream of, talking heads, shouting hot stock picks, dramatic sound effects. It creates this feeling of FOMO, fear of missing out, like you always need to be doing something.
Right, chasing the next big thing.
Exactly. And it leads to information overload without any clear, actionable guidance. So what happens? Many people just feel totally overwhelmed and put their finances on autopilot, maybe stick it all in a default fund.
And just hope for the best.
And rely on hope as their primary strategy, as the book puts it so powerfully, which is, let's face it, a really dangerous and unreliable approach when your future's on the line.
Okay, so we've got these external challenges, the system, the HFT, the noise. But Tony Robbins really emphasizes the internal battle too, right? Our own beliefs, our own behaviors. How do we get in our own way?
This is such a critical piece. The book dives deep into behavioral finance, basically exploring why we humans don't always act rationally with money, even when logic says we should.
Like holding on to a losing stock way too long.
Exactly. Hoping it'll come back when all signs point to selling. Or, procrastinating on starting to save because we're waiting for the perfect time, which, spoiler alert, never actually arrives.
So it's not just willpower.
Not necessarily. The book talks about cognitive illusions. These mental shortcuts or biases our brains use that make us think we're making sound financial choices, but we're actually walking into traps.
Our brains are kind of wired to trick us sometimes. The lottery ticket example really highlights that.
It's a perfect illustration. The book points out the average American household spends around $1,000 a year on lottery tickets. $1,000?
Despite the astronomical odds against winning.
Right. You're 251 times more likely to be struck by lightning than win the Powerball jackpot. Yet people keep buying tickets. It shows how strong these irrational tendencies and illusions are. Daniel Early, the behavioral economist, is mentioned, explaining how these cognitive illusions drive so many of our mistakes. We think we're in control, making rational choices.
But our wiring leads us astray.
Precisely. The book aims to shine a big bright light on these hidden mental traps so you can recognize them and hopefully avoid falling into them.
And maybe the biggest internal hurdle, the one that really keeps people stuck, is our own limiting beliefs, the stories we tell ourselves about money.
This is huge. profound, really. Those unconscious fears, those perceptions like it takes money to make money, or I'm just not good with numbers, or rich people are greedy. These deep-seated stories can absolutely paralyze us.
But the book offers hope by shattering those myths, right? Like the story of Theodore Johnson.
Exactly. Theodore Johnson, the UPS driver who never earned more than $14,000 a year. Yet, through disciplined saving and the magic of compounding, he built a fortune worth over $70 million.
$70 million on a UPS salary. That's incredible.
It completely shatters the myth that you need to be rich to get rich. His story is proof that consistent action trumps high income. And that's what this book is, according to Robbins. It's a blueprint, an actionable plan to arm you not just for today, but for life.
To get you from where you are now financially to where you really want to be by tackling those internal blocks first.
Exactly. Overcoming those is often the first and most important step.
Okay, so we've laid out the problems, the system flaws, the HFT, the noise, our own internal roadblocks. It sounds daunting. How does Tony Robbins propose we actually navigate all this? What are the core ideas we need to grab onto to really master the game?
Right. So master the game, for Tony Robbins, starts with recognizing that money is a game. But crucially, it's not a trivial one. It's a game your family literally can't afford for you to lose.
So it's serious, but it has rules we can learn.
Precisely. It's about understanding those rules, learning the strategies from the world's most successful financial players, the people who are winning, and applying them yourself.
It means understanding the psychology, both yours and the markets, and the system itself.
Yes, and this is key, taking massive, decisive action, not just thinking about it, but doing it. The goal isn't just stability, it's achieving true financial peace of mind. The book really promises to equip you to do more for yourself, for your family, and ultimately to contribute more broadly.
And a concept that just echoes throughout the book, the real secret sauce maybe, is the power of compounding. He calls it your personal money machine.
It's foundational. He emphasizes that real wealth isn't typically built just from a paycheck, no matter how big. The secret is shifting your mindset, your identity, from being just a consumer to being an owner, an investor.
Like Theodore Johnson, the UPS driver. His story wasn't about his paycheck size.
Not at all. It was purely about the relentless power of compounding interest applied consistently over decades. Think of it like that snowball rolling downhill. Start small, your initial investment.
But it picks up more snow, the returns.
And then that bigger snowball picks up even more snow faster and faster. It's exponential, not linear. That's the magic. Time and consistency are the fuel.
And the book shows even small amounts matter, right? Like $40 a week.
Yeah, it illustrates how even just $40 a week consistently invested can potentially lead to over $1 million difference by retirement compared to not saving. It turns that small, steady stream into a financial tidal wave over time.
So the key is automating it, making sure that machine just keeps running.
Absolutely. The number one action step is to set aside a portion of your income automatically. Send it straight to an investment account, your freedom fund, and basically lock it away. Treat it like a bill you have to pay, a sacred commitment.
But starting can feel painful, like you're losing that money from your budget right now.
Totally. That perceived loss is a big psychological hurdle, which is why the book heavily promotes the Save More Tomorrow strategy, or SMART. Brilliant idea from Shlomo Benartzi and Richard Thaler.
How does that work again?
It's simple but genius. You commit today to automatically increasing your savings rate with your next pay raise, not out of your current income.
Ah, so you don't feel the pinch because it's money you haven't gotten used to spending yet.
Exactly. It bypasses that pain of loss. The book even has this great visual showing different lifestyles linked to savings rates, like 3.5% save might afford you new sneakers, but getting up to 13.6% or more could mean luxury cars and real comfort. It makes the benefit tangible.
Okay, let's talk about one of the most eye-opening parts. Debunking the 9 myths of investing. This feels like critical insider info. Myth number 2. Our fees. They're a small price to pay. That sounds familiar.
Oh, it's a huge myth the financial industry loves. And the book just blows it apart with facts. Get this. An incredible 96% of actively managed mutual funds fail to beat their benchmark index over the long run.
96% fail to beat the average.
Over sustained periods, yes. Yet they charge fees that average around 3.17% annually, according to the research cited. Now, 3% might sound small.
But compounded over decades.
It's devastating.
The book shows those fees can easily eat up 50% to 70% of your potential future nest egg.
Right.
Half or more of your money gone to fees for funds that usually underperform anyway.
And the managers often don't even invest in their own funds.
That's another kicker mentioned. It highlights a fundamental misalignment of interests. They get paid regardless of whether you make money. It's a silent killer of wealth accumulation.
So if actively managed funds are usually a bad deal, who are the masters? Who should we be listening to? The book dives into the Billionaire's Playbook, right?
Yeah.
Interviews with financial legends.
Yes, and the wisdom in this section is gold. It often directly contradicts mainstream advice. Take Jack Bogle, the founder of Vanguard.
The index fund pioneer.
Exactly. His idea of low-cost index funds just mirroring the market instead of trying to beat it was initially mocked as Bogle's folly. Why? Because it threatened the high fees of active managers.
But it became a multi-trillion-dollar empire.
A $2.86 trillion empire built on that simple, powerful idea. He did the math. Active management costs maybe 2% of your year in total fees and training costs. Over 50 years, $1 might grow to $10.
Yeah.
But a low-cost index fund, maybe 0.05% fee, that same dollar could grow to $30.
3 times more just by cutting fees.
Huge difference. His mantra was nobody knows nothing about predicting the market consistently, so just buy the whole market cheap.
And Charles Schwab, founder of the brokerage firm, he basically says the same thing.
Pretty much, which is powerful coming from him. He advises that 98% of people should primarily use low-cost index funds. Why? Predictable outcomes, low costs. He's candid. Most people just don't have the time, skill, or resources to be Warren Buffett or, frankly, himself.
So for almost everyone, passive indexing is the smarter play.
Statistically, strategically, yes.
Then there's Ray Dalio, founder of Bridgewater, one of the world's biggest hedge funds. His all-seasons portfolio is legendary, and the book breaks it down.
It does. Dalio's genius was creating a portfolio designed to perform reasonably well in any economic weather: growth, recession, inflation, deflation. The core idea is revolutionary. Diversify risk, not just dollars.
What does that mean, diversify risk?
It means realizing that even if you split your money evenly between stocks and bonds, stocks are way more volatile, so they actually represent much more of the portfolio's risk. Dalio's approach balances the risk exposure across different asset types that behave differently in different economic conditions.
So how does he suggest we actually allocate the money to balance that risk? What's in the all-seasons portfolio?
It's designed for resilience. The allocation is 30% in stocks, like an S&P 500 index, 15% in intermediate-term government bonds, 40% in long-term government bonds.
40% in long-term bonds, that seems high.
It does, but they tend to do well when stocks struggle, like in recessions or deflationary periods. They provide that balance. Then 7.5% in gold and 7.5% in a diversified basket of commodities.
Gold and commodities for inflation protection.
Exactly. And the historical performance cited in the book is impressive.
Mm-hmm.
From 1984 to 2013, it apparently averaged nearly 10% a year, net of fees. And crucially, it made money in over 86% of those years, with very small average losses in the down years.
So it provides a smoother ride, less panic.
That's the idea. It provides emotional scaffolding, as the book says, to help you stay invested through the inevitable market turbulence because you know it's built to withstand different conditions.
These insights are game-changing, but the book goes even further, introducing tools usually only for the super rich, promising upside without the downside. That sounds almost too good to be true. Fixed indexed annuities.
FIAs, yeah. They can sound too good to be true, and you need to understand them properly, but they offer something unique. They're insurance products, fundamentally.
Not investments.
That's right. Insurance products that offer 100% principal protection guaranteed by the insurance company itself. So your initial money is safe. Then you get to participate in some of the stock market's gains, usually up to a limit or cap.
Okay, see some upside.
But, and this is the key, if the market crashes, your principal doesn't go down. It's protected. And any gains you do lock in, usually annually, become your new floor. Your account value can only go up or stay level, never down from that locked-in point.
Like a ratchet effect.
Exactly.
Right.
It's like a financial escalator that only goes up. Now, there are trade-offs. The caps limit your upside. There can be surrender charges if you pull money out early. But for someone nearing or in retirement who prioritizes safety, that principal protection offers incredible peace of mind. The book stresses choosing highly rated, financially strong insurance companies.
Makes sense. And what about structured notes? Similar idea.
Similar concept of engineered safety, as the book calls them. These are typically issued by major banks. They also often offer 100% downside protection on your principal, over a set term, maybe 5 or 7 years.
And the upside.
You usually get a percentage of an index's return,
Mm.
maybe 90% of the S&P 500's upside over the term, for example. Again, the crucial factors are the financial strength of the issuing bank for debts. The book mentions Canadian banks' historical stability as a positive example, and scrutinizing the fees.
Fees can be tricky there, too.
They can be terrible, as the book warns, if you're not careful. But if structured well, they offer what Kyle Bass, another interviewee, calls asymmetric risk-reward, potentially large upside with defined limited downside, like risking 3 cents for every dollar of upside. Sophisticated tools, but becoming more accessible.
So we've gone through all these strategies, the numbers, the market mechanics, but then the book kind of pivots, saying the ultimate truth isn't really about money at all. It's about emotion, the inner game.
This is where Tony Robbins really brings it home. It's perhaps the most profound takeaway. The quality of your life, he argues, isn't dictated by events, how much money you have, market crashes, whatever. It's controlled by the meaning you assign to those events.
How you interpret things.
Exactly. And to understand that, he introduces the 6 core human needs that drive everything we do: certainty, variety, significance, love connection, growth, and contribution.
And how do these needs tie into our finances? This sounds more like psychology.
It is, but it's directly relevant. Our financial behaviors are often driven by trying to meet these needs, usually unconsciously. For example, if your top need is certainty, you might hoard cash or only buy ultra-safe investments, missing out on growth because market volatility feels terrifying.
Or if you need significance.
You might overspend on flashy cars or designer clothes to feel important, draining your savings in the process. The genius here is realizing which need you're trying to fulfill with money. Once you know that, you can find healthier, more direct, and often cheaper ways to meet that need.
Ways that don't involve messing up your finances.
Precisely. It frees your financial decisions from those unconscious, often destructive drivers. It's a total shift from just accumulating stuff to finding real, lasting fulfillment.
And the most surprising secret to wealth and happiness, according to the book, isn't getting more, it's giving.
Sounds counterintuitive, right? But yes, the book presents compelling evidence, studies even, showing that pro-social spending money on others, or donating to causes, actually increases our own happiness and even improves physical health. It doesn't matter how much you give.
So giving literally makes you richer, in a sense.
In the sense of well-being and happiness, absolutely. It seems we're wired for it. Tony shares his own powerful story from when he was 17, struggling himself, but using his janitor earnings to buy Thanksgiving dinner for 2 families in need.
And that act of contribution changed him.
Profoundly. He describes the intense joy it brought him, lifting him out of his own despair. It taught him that contribution, that giving, isn't about having money. It's about a state of being, and it's fundamental to a truly rich life.
Wow. Okay, so we've covered the problems, the core ideas. Now for the really practical part. How can listeners immediately apply these ideas? Starting today, what are the steps?
Right. This book is all about action. Step 1, the absolute foundation, what Tony Robbins calls the most important financial decision you'll ever make. Automate your savings.
Not just think about it, actually do it now.
Today, set up an automatic transfer, an auto deduct from your paycheck or checking account, straight into a dedicated Freedom Fund investment account. Commit to a percentage, even if it's small to start. Just start and stick with it, in good times and bad.
That consistency builds the money machine.
It does. And if you can, enroll in that Save More Tomorrow plan we talked about. Commit to automatically increasing your savings percentage by 1% or more with every future pay raise. Painless progress.
Step 2, become an insider. Choose your guides carefully.
Yes, this is critical given the conflicts of interest we discussed. The book strongly urges you, avoid brokers who work on commission. Seek out a fiduciary.
What's the difference again?
A fiduciary, typically a registered investment advisor, RIA, is legally obligated to act in your best interest. They usually charge a fee based on a percentage of your assets, not commissions for selling you specific products. Their success is tied to yours.
How do you find one?
The book suggests resources like the National Association of Personal Financial Advisors, NAPFA website, napfa.org, or Tony partnered with a firm, Stronghold Financial, offering a complimentary review of your current portfolio to check fees and alignment. Also, look closely at your 401k.
Ask about the fees there, too.
Definitely. Ask your plan administrator for a full breakdown of fees and investment options. The book cites audits finding many plans had excessive or hidden fees. Consider rolling old 401ks into an IRA where you have more control and can work with a fiduciary.
And embrace low-cost index funds.
Absolutely. Following Jack Bogle's advice, shift away from those expensive, underperforming, actively managed mutual funds. Reduce fees, maximize your returns. It's simple but powerful.
Okay, savings automated, good advisor found. Step 3, make the game winnable. Define your dreams and speed things up.
This is about getting crystal clear on your targets. Use the book's framework or an app based on it to actually calculate the income needed for different levels of financial freedom. Security, vitality, independence, absolute freedom.
Knowing the exact number makes it real.
It empowers your brain to start figuring out how to get there. Vague hopes become concrete goals. And the book argues these numbers are often much smaller and more achievable than people imagine.
And how do you accelerate getting there? Mindful savings and earning more.
Exactly. Two sides of the coin. First, attack your expenses. Use the book's 6-step exercise to scrutinize recurring costs. Insurance, phone bills, subscriptions, daily coffees. Be purposeful with spending.
Cut the fat.
Right. Second, and this is a big one, invest in yourself to earn more. Add more value. This isn't just about working harder. It's about working smarter. Learn new skills.
Like the teacher Ki-hoon or the designer Daniela in the book.
Perfect examples. Ki-hoon learned to teach online, adding massive value and earning millions. Daniela learned cutting-edge digital marketing, making herself indispensable and boosting her income exponentially. It's about increasing your earning potential, whatever your field.
The book also talks about taxes and even location as accelerators.
Huge levers. First, use Roth accounts whenever possible. Roth 401ks, Roth IRAs. Pay tax on the seed, your contribution now, so the harvest, all the growth and withdrawals, is tax-free later. Protects you against future tax hikes. It's brilliant.
Pay taxes on the small amount now, not the huge amount later.
You got it. Second, seriously consider your zip code. The difference between a high-tax state like California, 13.3% top rate mentioned, and a zero-income tax state like Florida is massive. The savings could pay off a mortgage in years.
Or even move abroad.
The book encourages thinking globally. Places like Bali, Costa Rica, parts of Europe or South America can offer amazing lifestyles at a fraction of the cost, dramatically speeding up your path to financial independence. Optimize your location.
Okay, step 4. Strategic asset allocation. Put Dalio's all-seasons portfolio into action.
Right. Implement that risk-balanced allocation we discussed. 30% stocks, 15% intermediate bonds, 40% long-term bonds, 7.5% gold, 7.5% commodities. This is your core strategy for resilience.
And the buckets.
Allocate your assets into those buckets. The security peace of mind bucket holds your safe money, the funds you absolutely can't lose, maybe using some of those FIA or structured note strategies. The risk growth bucket is for higher return potential, like your stocks. And the dream bucket is for fun, lifestyle goals, and giving.
And rebalancing is key.
Crucial. Periodically, maybe quarterly or annually, adjust your portfolio back to those target percentages. Sell some winners that have grown too large, buy more of what's lagged. It forces discipline, buy low, sell high, and prevents emotions from derailing your strategy during market swings.
Got it. Step 5. Secure lifetime income, especially as you approach retirement.
This is where those fixed indexed annuities, FIAs, really come into play. If you're nearing or in retirement, explore options from top-rated insurance companies. They can provide that guaranteed income stream for life, like a personal pension, ensuring you don't outlive your money. Ultimate peace of mind.
And the final step, step 6, brings us back to the beginning almost. Master your inner game.
This is where the lasting change happens. First, change your story. Identify those limiting beliefs, I'm bad with money, it's too late for me, and consciously divorce them. Replace them with empowering truths, inspired by people like Theodore Johnson.
Second, change your state.
Yes. Remember, emotion is created by motion. Feeling fearful or stuck, get physical. Stand up, move, breathe deeply, adopt a power pose. Shift your physiology to shift your psychology. This allows you to take massive action instead of procrastinating.
And third, practice gratitude.
Daily. Cultivate appreciation for what you do have right now. This simple practice, the book says, helps you stand guard at the door of your mind. It stops those negative weeds, frustration, fear, scarcity from taking over. It lets you feel rich now, which fuels positive action.
That's a powerful set of steps, a real blueprint. But, as people listen, questions must be popping up like, okay, index funds sound great, but which ones? How do I choose?
That's a super practical question. The book generally advocates for broad market, low-cost index funds that track major indexes, like the S&P 500 for U.S. stocks, or total market indexes for broader diversification, maybe international indexes too. The key is low cost. Look for expense ratios under, say, 0.10% or even lower if possible. Vanguard, Schwab, Fidelity all offer excellent options. The specific mix depends on your overall all-seasons allocation.
Right. And what about someone buried in debt? You mentioned prioritizing it, but where do they even start if they feel totally overwhelmed by credit cards or loans?
Great follow-up. The book emphasizes tackling high-interest debt first, aggressively. Strategies like the debt snowball, paying off smallest debts first for psychological wins, or debt avalanche, paying off highest interest debts first to save the most money, are effective. The key is to pick one, make a plan, automate extra payments if possible, and be relentless. Getting out from under high-interest debt frees up enormous mental and financial energy to then build wealth. It has to be step 0 if that's your situation.
Okay, that makes sense. What about variable income, freelancers, business owners? How do they automate savings consistently?
Yeah, that requires a slight adaptation. Instead of a fixed dollar amount from a steady paycheck, automate a percentage of every payment received. Client pays an invoice, a set percentage automatically transfers to your Freedom Fund. Big sales month, more goes in. Leaner month, less goes in, but the habit remains. You might use separate bank accounts or apps to manage this profit-first approach. The principle is the same. Pay yourself first, consistently, just adapting the mechanics to fluctuating income.
And one more on the portfolio rebalancing. How often is often enough? Quarterly? Annually? Does it matter?
The consensus, and what the book implies, is that you don't need to overdo it. Quarterly or annually is generally fine for most long-term investors. Some people do it if an asset class drifts too far from its target, say by more than 5%. The goal isn't perfection. It's maintaining the strategic balance and discipline over time, preventing emotions from taking over. Annually is often simplest and perfectly effective.
Excellent clarifications. Really helps connect the dots to real-life situations. So you've just journeyed through a deep dive into mastering the game of money. And hopefully what you've discovered is that real financial freedom isn't some impossible dream just for the Wall Street wizards. It's actually an achievable reality for you.
Built on proven, understandable strategies, and importantly on mastering your own psychology, your inner game. It's not just about getting rich, it's about unlocking a life with more joy, more impact, more contribution, and definitely more peace of mind.
You genuinely now hold the blueprints. You've heard the distilled strategies from some of the world's best financial minds. You understand the system's quirks and how to navigate them. You know the importance of your inner state.
You have the tools. The knowledge is there to avoid the pitfalls and confidently build that secure future for yourself, for your family.
And this is the absolute crux, isn't it? Here's the stark truth. Knowledge without action.
Yeah.
Just an interesting dinner party conversation. It's intellectual curiosity.
Right. The market doesn't reward what you know. It only rewards what you do. Your good intentions, your understanding of compounding or asset allocation, they mean nothing until you act.
That gap between knowing what to do and actually doing it, that's often the biggest financial hurdle people face.
So the real question now is, what will you do with this gift of insight? Will you let those weeds of frustration, fear, procrastination just keep growing in the garden of your financial future?
Or will you decide right now to stand guard at the door of your mind? Will you commit to taking consistent, even small actions starting today to build that future you want?
The path is clear. The strategies are laid out. The choice, as always, is yours.
Will you play to win?